Hello, and welcome back to another episode of Fintech Recap. It's the beginning of a new month, or nearly, and so we wanted to have Jason Mikula, our co-host for Fintech Recap, join us for a fun conversation on what's happened in fintech over the last month or so. Normally, with these episodes, Jason and I will try to cover the waterfront and talk about a lot of different topics. This episode, there were two stories that were so dominant in the fintech ecosystem and were so just taking up all the oxygen that we really wanted to focus on just two. Those two are, of course, open banking and the power moves that JPMorgan Chase has been making to reshape the open banking ecosystem to a image of its preferred liking. We also talk about the Genius Act, which just passed and was signed into law by President Trump. That has been a huge landmark achievement for the crypto industry, something that crypto advocates have been wanting and looking for a long time. It finally happened. And so Jason and I talk about what's next, where stablecoins and the crypto ecosystem are going, the impact it might have on the banking industry. We try to pull it apart as much while also recognizing the fact that we are not experts in stablecoins or crypto, which we will continue to admit to you, at least until we feel like we've fully come up to speed. As always, we carve out a little time at the end for things that we can't let go. Mine, of course, is related to Bill Pulte's Twitter account. Jason's is on a topic that is very near and dear to my heart, especially when I am in the mood to rant about something. So, great episode. As always, here is another edition of FinTech Recap. Okay, we are back at it again. Mr. Mikula, great to see you.
Good to see you, too. I understand you were recently in the swamps of Washington, D.C., possibly literally and figuratively?
It's true. It is true. So on a literal level, went to DC a couple weeks ago, and it's so hot, Jason. It is so hot. It wasn't even that hot, and it was actually kind of stormy when I was there, but it's so hot and it's so humid, and there's no like nice ocean breeze. I mean, like swamp in a literal term is deserved, unfortunately, for DC. And I love DC. I love visiting. I love walking around. But boy, you visit in July and like you are in for a world of hurt. And the problem I had, Mr. Mikula, was I went to go speak at a Federal Reserve event on financial inclusion, which was amazing and a great experience. And I learned a ton. But when you speak at the Fed, kind of have to wear a suit and dress up. And so I'm wearing this like dark gray suit walking around in an actual literal swamp. And then figuratively, I did get to see the construction project that has engulfed the Federal Reserve. I was in the building. I got to walk around the different parts of the building that were under construction. I had Bill Pulte's voice in my head as I was doing so, because I just am addicted to his Twitter account, as we'll talk about at the end of this podcast. And I was looking for signs of waste, fraud, and abuse. I did not see any. It seemed all very reasonable. It's a big old building, so I'm sure it costs a lot to renovate, but nothing too suspicious from my vantage point. I will say one of the things that was funny was, whenever you go to like DC, you always sort of run the risk, particularly if you're going to like one of these buildings, that there's going to be like protesters outside or strange people asking questions outside. And I did run into one gentleman who, while I was waiting for security to clear me so I could go inside, asked if I worked at the Fed. And I said, no, I'm just visiting. And he's like, very calmly and very like in a very normal voice was like, well, can I ask you a question? I'm like, yeah, sure. And he's like, do you think it's possible that they are manipulating the macroeconomic environment to ruin my life? And I was like, well, and then right at that moment, security came and told me I was allowed to go in the building. And so I just sort of skedaddled away from that and got inside. So definitely some strangeness engulfing, I would say, both the Fed specifically and DC generally, but otherwise a fantastic experience.
That directionally reminds me of Trump's first term, and I was working at Goldman, and that was back when Trump appointed a lot of former Goldman people.
Right,
And
sure,
for
yeah.
a couple weeks, there were a crew of protesters in front of Goldman's office that I had to walk by on the way into work and like avoid eye contact because frankly I probably agreed with them, but that just I didn't think that was going to be believable. So
right. You're like, trust me, I get it. No, I mean it is a strange world when those things collide. I also did get a chance to walk by the apparently not quite entirely vacant CFPB headquarters. Apparently,
but
there are still
the sign. I saw you the
there.
last time you were in DC. The sign was already gone, right?
So yeah, sign is gone. It looked really empty. Honestly, it was strange. Maybe it was like my imagination sort of applying a filter on top of reality. But I swear the building looked more decrepit. Like it was starting to like collapse, as if like the mission had been sucked out of it and all the energy was causing the actual structure to decay. But it was a sort of surreal experience. We're going to get into a few of these topics actually because unlike some other fintech recaps where Jason and I have a huge long list of a bunch of little stories we want to talk about, we pretty much agreed immediately that there were two stories we were going to talk about for today's podcast. So, Mr. Mikula, first of all, I will just preface off the top, no visit to BaaS Island. Yay! And second, is it okay if I lead off and then you hit us with the second topic?
I am proud that we exercised self-control to limit ourselves to two topics. And yes, the first topic is relevant to the goings-on in, well, former CFPB, current CFPB, tangentially related. So please get us going.
Okay, I will do it. So as listeners, I'm sure know, because Jason and I have been writing and talking about it a lot, it was reported by our friends Evan and Paige at Bloomberg that JPMorgan Chase intends to begin charging fintech companies and data aggregators for access to their customers' data. Now, this is a huge story in the world of fintech, and I think at least leaking somewhat into banking. According to Bloomberg, JPMorgan Chase sent around a pricing sheet to all the data aggregators: Plaid, MX, Finicity, Akoya, name your data aggregator. And couple of things about that pricing sheet. One, the pricing is really high, reportedly. And this is not just Bloomberg reporting. Jason, I think you sort of independently reported through sources. I did the same, that the pricing is quite high. From my reporting, up to about 10x what the data aggregators charge their end customers currently for access to the data. It's based on volume tiers. So the more data pulls you have, the cheaper your price gets, which is pretty common as a pricing structure. And most interestingly, the pricing is broken out into two different buckets: one for payments related use cases and one for non-payments related use cases. And the distinction there is essentially if you are pulling a tokenized account number, which is the sort of tokenized version of an account and routing number that you would need to use for any payments use case, whether it's funding an account after you book a loan or facilitating an ACH payment or what have you. Any payments use case that accesses a TAN, a tokenized account number, that is a much higher price, again, about 10x what non-payments use case, which could be anything from budgeting and PFM to cash flow underwriting. Those use cases are less expensive. Now, Chase has argued that it has invested significant time and resources in creating and maintaining a secure system to facilitate this data sharing, and that they are justified in recouping their costs for doing that. Not an entirely unreasonable argument, an argument that others have made a central argument in the Bank Policy Institute's lawsuit against the CFPB's rule on open banking, which is relevant to the story, and we'll get into that in a second. Interestingly, after this initial story broke, Evan at Bloomberg Law did some great additional reporting and found an unnamed political appointee at the CFPB who shared some concerns about the reporting of JPMorgan Chase charging for the data. And I'll quote from Evan here. He wrote, "The official, in conversations with fintechs, is probing whether the agency's bid to kill a Biden-era open banking rule in court may have opened the door for charges. according to multiple people with knowledge of the situation who asked to remain anonymous to discuss internal deliberations. So apparently the CFPB was sort of surprised that JPMorgan Chase was A, charging money, and B, charging as much money as they are. I am surprised that they were surprised, but let's just set that aside for the moment. Unsurprisingly, and I think everyone expected this to happen, it's been reported that other large banks are considering following suit. PNC CEO Bill Demchek, noted despiser of open banking, was asked a question on the bank's earnings call about fintech data access, and he said, "We're in discussions on it. I applaud what JPMorgan Chase did. I think they're exactly right. I think there's a big cost to keeping this data secure and producing it in a form that's readable for our clients. So we're, thinking about it." So, Jason. I would love to get your sense of what you think this news means, the larger context in which it's happening, which obviously, again, as I referenced, the CFPB finalized a rule in October. It was immediately challenged by the Bank Policy Institute and a small Kentucky bank and the Kentucky Bankers Association, which really just means it was challenged by the Bank Policy Institute, along with finding the right venue for their case. The CFPB, as we just discussed, under Acting Director Russ Vogt, it's basically been engaged in a all-out war to reduce the CFPB down to its minimally viable state, or minimally unviable state, I suppose you could say. The CFPB actually switched sides on this issue and asked the court to toss out the rule altogether. So, all of this broader context is happening around the gutting of this rule. And now we have Chase. So what do you think? Did this surprise you? Were you shocked by any part of this, or was this something that you sort of expected to happen eventually?
I was not surprised. I mean, as you've pointed out and nicely summarized, this was one of the core complaints or core arguments contained in that lawsuit filed by Forsh Bank, Kentucky Bankers Association, and BPI representing basically the nation's largest banks. This was one of the main arguments in that lawsuit, that Section 1033 of Dodd-Frank, which, let's remember, was passed 15 years ago, did not specifically authorize the CFPB to prohibit the charging of fees. That was basically, in my mind anyway, the biggest and most substantial piece of that still ongoing lawsuit, with some additional...
It's what they were pissed about. That was if you really got down to the root of why they were so mad, it was that. There were other issues too, but that seemed like the big one, right?
Yeah, there were some APA arguments about it was arbitrary and capricious, and you didn't do XYZ when you were formulating the rule, blah, blah, blah. But the main thing is they're mad that they have to give away this data for free, or incur cost in order to give away this data that then the aggregators, Plaid, Finicity, MX, whomever, go on and charge fintechs to consume. I mean, I think so to answer your initial question, no, this was utterly obvious. And of course this was going to happen. I will say the piece that I was maybe slightly surprised at was how aggressive the pricing is.
Yeah,
I'm guessing that you, me, Evan, Paige, and everybody else probably all talk to an overlapping set of people.
I'm sure.
One of whom used specifically the word punitive, and sort of the consensus among the various sources I spoke to was this is an effort to functionally kill this industry or this practice, which at the price point that you mentioned, and in the Bloomberg piece, it uses the metric for a single data pull, the amount of the cost to pay Chase for the data would be 1,000% more than the revenue generated from that data point, right? And at that point, many of the use cases, and hopefully we have time to talk through some of the actual potential consumer impacts, but many of the use cases would just become economically impractical, right? Yeah. So, I mean, when I was sort of looking at this and trying to think through sort of how how does this evolve? How does this move forward? It's worth remembering, one, the lawsuit we're discussing, the challenge from BPI, which in my head is just a challenge from Chase at this point, but
yes.
Big banks.
Yep.
That lawsuit's not done, right?
No.
FTA, the Financial Technology Association, which largely represents non-bank fintechs, was granted the right to intervene and filed a motion for summary judgment, arguing its side of things. And that has not been decided yet. So as of today, and presumably as of the time we publish this, the open banking rule remains. It is finalized. The earliest effective date, and I don't have this in front of me, but it's sometime in 2026.
Yeah.
Right. So in theory, nothing has changed. The fact that JPMorgan Chase would go ahead and not only say we want to start charging, but propose pricing that would functionally, kill off many of these use cases is sort of a very aggressive opening negotiating position. So I'm kind of curious to see where that goes. The actual lawsuit itself is unresolved. So there's a chance that the rule is preserved as is, although that feels a bit unlikely, given that the judge in the case actually refused to allow other trade groups to file amici briefs, the plural of amicus.
Yeah. There's that Latin paying off.
Yes. 3 years of Latin paying off handsomely. And I mean, I guess one last thing before I throw it back to you that I was maybe a little bit surprised about was sort of the intensity of the industry freak out at this development, right? So I mean, it feels like it was in theory, relatively minor piece of news on its own. Yeah. But I think in the wider context of this sort of, ongoing battle between big banks and fintechs, it sort of feels like the advantage perhaps has shifted a little bit given the gutting of the CFPB and some other sort of political machinations. And what the actual impact on these fintech firms, and more importantly, on the overall competitive environment and what services consumers do or do not have access to, there's potential risk that this could have a very serious impact, particularly on one of the topics I know that is close to your heart, which is cash flow based underwriting.
Yeah, no, it's exactly right. I mean, so let's talk about use cases because I do think there is a bit of an element of Chase kind of playing a strategic game here, right? Because obviously, and there's been really interesting commentary, kind of representing the other side of the argument from folks kind of, I think, closer to banks or kind of taking more of a bank perspective on this, right? Tom Noyes has been very active on Twitter, sort of arguing the bank side of this. In fact, he was sort of tweeting about it before the news broke that week. So it was kind of in the water supply a bit that week. Ron Shevlin has written a couple of pieces kind of arguing kind of the Chase side of things. I mean, I think that it's absolutely reasonable for banks to want to charge something for this, right? Like it is a cost. I've always been a little unsympathetic to Chase saying like how expensive it is given just how profitable Chase is. But like, if you think about this requirement being applied to all banks globally, like there is an expense to standing up these APIs, to maintaining them. The volume of requests going through these APIs has really increased over time. Like I don't think it's entirely unreasonable to be able to charge for the data. But as you illustrated, and this was the thing that I think caught everyone by surprise and why it engendered such pushback on the fintech side, the pricing is just astronomically higher than what would be sort of reasonable in terms of covering your cost, right? And it's hard to say how exactly Chase came up with the formula for determining what the costs were. I mean, any type of like cost calculation inside, particularly a large bank like that, you can take in all your infrastructure costs across the entire bank and say, this thing needs to pay for all of this. Like, how do you divide up some of those shared costs? So it's an interesting question, but just practically speaking, if you're charging, and I heard this from a couple of different folks I spoke to, if you're charging roughly the amount of money that these large aggregators make in total revenue for a year, or if you're charging the amount of money, like in the case of a smaller aggregator that I was speaking with, the amount of money that they've made over the entire course of their existence, just in fees for 1 year.
I heard these same data points, so people are sticking to their talking points.
Well, they really are, and it's like, I mean, that's that's a different kettle of fish, right? And that speaks to sort of a strategic intent by Chase to sort of target maybe not all of open banking, but at least certain types of open banking or use cases that are competitively concerning to them. And I'll hone in on payments, right? Because obviously the pricing sheet shared by Chase charges two different prices, one for payments use cases, one for non-payments use cases. I find it fascinating that just if you think about it from an infrastructure perspective, which tends to be how banks talk about the burden of open banking, right? All these calls on our API, our system is just strained with like all of this traffic, all this stuff. It is actually much less burdensome on your infrastructure to facilitate payments use cases than it is to facilitate, let's just say, budgeting and PFM use cases or earned wage access use cases, right? A payments use case, like if you want to facilitate, money moving out of a Venmo account, like in the old days, you might get authorization from a consumer, get their account and routing number, and that account and routing number doesn't change, and you only have to get it one time, and then you can use it for years and years and years without ever having to in any way reach back out to Chase or another bank and get an update on that information. By contrast, if it's a budgeting use case or it's an earned wage access use case, you have to monitor that account continually, like day in, day out, even multiple times a day to make sure that you're looking at the amount of money in the account, transactions. Like it is a monitoring based use case where the infrastructure impact is much heavier. So I have sort of a hard time understanding the rationale for charging 10x for payments use cases to non-payments use cases if, again, the only rationale is, hey, look, we need to cover our costs here. By contrast, what we know to be true, because Chase has said this in their comment letters to the CFPB and in their complaints about open banking throughout the rulemaking process over the last couple of years, is they hate pay by bank specifically as a use case. They don't like it. There's been reporting internally at Chase that it's really split the bank in a lot of ways, where there are some parts of the bank that are sort of actively pursuing it. In fact, Chase has a pay by bank division or business or product line that they built in partnership with Finicity. And then on the other hand, they have like a huge, massive credit card and debit card business that they're very protective of. And, if you read some of the comment letters that they submitted to the CFPB, like they went really explicitly out of their way to make it clear to the Bureau that they thought payments was out of bounds for what should exist around open banking. And the pricing, I think, reflects the fact that, they might not have a huge problem with, cash flow based underwriting. They might not have a huge problem with budgeting use cases. I mean, they want to get paid for it, and the amount they're charging is probably still so high that it might make that sort of economically unviable. But the use case they seem to be trying to destroy the economics of, just looking at the data that's been reported, is payments use cases. And I don't know, man. I mean, we don't live in a world where sort of antitrust concerns around large incumbents really are taken super seriously these days, it seems. But like that to me is the part that verges into, okay, this is not like a good faith effort to recover costs or even to share in the economic upside of what your data is enabling. This seems very much like an incumbent trying to protect a specific line of business. And I think that of all the different examples or use cases, that's the one that jumps out to me.
Yeah, I mean, I wouldn't, necessarily expect ideological consistency from a behemoth corporation that is seeking to, protect the economics of its business.
Sure.
I mean, I think I actually saw that you may have cited also a recent shareholder letter from JPMorgan Chase on some of these like similar topics and themes.
Yeah.
And I was like, well, offering a bank account also is not free, right? Yeah. I'm actually looking at Jamie Dimon's 2024 letter, shareholder letter, where he cites that it costs the bank approximately $225 to maintain an account, which he says $150 is a fixed expense. And some of what he's talking about in that portion of the letter is this is a throwback, a perennial throwback for fintech, is complaining about the Durbin Amendment and the impact of the Durbin Amendment, saying that when that passed and went into effect, debit revenue dropped from $130 to $60.
Yeah.
It's like, okay, I mean, there's a lot of different ways I can go with this, but it's like, well, generating and mailing a paper statement costs money.
Yeah.
You know, as a government that formulated regulations, one of the things we said is you have the obligation to provide customers with a periodic statement. Certainly, we've seen that change over time from being, mailed, a physical printed mailed thing in most cases, to something you're looking at either in an online banking portal or your banking app on your phone or whatever. But we don't say, oh, well, this is a burden that we're going to a la carte charge the customer for.
Right.
So while I wouldn't necessarily say this is my own point of view that I've adopted, but I do think there's a reasonable argument to be made that if you are offering a consumer a checking account, a savings account, a credit card account, whatever, part of the baked-in functionality that you're agreeing to provide is the ability for that consumer, consistent with law, to have access to that data in a whatever machine-readable format, whatever the language from 15 years ago says.
Right.
So, I don't have a ton of sympathy, again, particularly for JPMorgan Chase, which is like a $3 trillion, institution. It costs money to provide this. It also costs money to print and mail a paper statement,
or to have branches, or to have anything. And I think the other part that's interesting is just building on your Durbin Amendment point, because I think it's a really good one, and Jamie Dimon talks about it a lot over the years. It just really bugs him, but he'll frame it as this is unfair, and you're like, okay, I guess that's true. Although you're the largest bank in the country, you are the definition of an incumbent. In fact, you are sort of implicitly guaranteed survival by the U.S. government because you're so big that we can't even afford to let you fail. I mean, I have not a ton of sympathy for the unfairness point, but it's okay, that's we can talk about who should be winners, who should be losers under these arrangements. But the problem I have is he'll extend the argument to, this is going to be bad for consumers. This is going to hurt consumers. And in the case of the Durbin Amendment, what he talks about is the Durbin Amendment, and this was actually a quote from him a while back. He said, caused 5 to 10 million people in the U.S. to become unbanked because of high banking fees and others driving them out of the banking system. And I find that to be such a disingenuous stat to claim or to share, because if you look at the FDIC's data over that time period, the rate of unbanked households in the U.S. has actually dropped by about half, right? It's gone from 8% of households to about 4% between 2010 and 2023. And I think, so again, from Jamie Dimon's perspective, it's hey, this hurts our profitability, it's unfair, and it hurts our ability to serve these customers. And because we can't serve these customers, I think the assumption is no one can serve these customers. But the problem is, with that logic, just because it hurts your ability to serve these customers doesn't mean it doesn't empower someone else to serve these customers. And I would argue that the Durbin Amendment actually created a whole range of new competitive offerings for those consumers, which probably is why the unbanked rate in the US went down. So just because it hurt your ability to compete in certain areas doesn't mean it hurt consumers. And I see that conflation of those two ideas with the Durbin Amendment. I see it in open banking. It's a talking point that comes up again and again with banks. Sorry, I interrupted you.
No, not at all. I mean, everything always goes back to Durbin if you talk long enough. And I had a double espresso right before we started recording this, so I'm extra amped up today.
Yes.
I mean, one more piece of this I want to make sure we fit in is, sort of, okay, let's say Chase proceeds with this pricing that is so high that it becomes impractical to continue to use these APIs that they've built to facilitate data sharing. A question that a lot of people asked me, which in turn I asked other people, was, well, can't we just go back to screen scraping? Like that's what we did before these APIs were built. If Chase wants to charge a gajillion dollars to access their API, like whatever, let's just collect the consumer's username, password, and go scrape it out like we used to. I mean, I heard a couple of interesting different theories on sort of the practicality of that, and then I also want to hear your take on it, since you're smarter and better plugged in than I am. But one was just that the sheer volume has increased literally orders of magnitude. I mean, many, many billions of these API calls or data calls are being made. And to sort of try to just revert back to we're going to use scraping to do that, one, may be impractical. And if not impractical, two, if being done by a centralized aggregator, will be very significantly easier to detect and block compared to what it would have been, in 2015, 2016. Ironically enough, when you're trying to link an account and it doesn't work, who does the consumer usually get mad at and call? The bank. They're not calling Plaid or Finicity or MX.
I don't even know that they have customer service numbers you can call. But no, I mean, it's exactly right.
One more quick thing, and you can respond to both.
Yeah,
was the idea that in an age of Gen AI, fintechs, instead of relying on a centralized intermediary like a Plaid, like MX, basically cobbling together their own janky screen scraper to avoid this problem altogether. And then the sort of security and usability concerns that may come with that. So I don't know what your reporting turned up as far as, can't we just go back to the good old days of screen scraping?
Yeah, no, it's funny, right? I've been thinking about it as like different like outcomes. I've been reading Goldilocks to my son a lot at night because you know how kids pick the same book and they just want you to read it over and over. So Goldilocks is one of the favorites right now. So reading Goldilocks every night's kind of burned into my brain, and it's like Papa Bear, Mama Bear, Baby Bear. Like one of them is like just right, and I think if you think about the different stakeholders involved in this, I actually think there was a world in which the big established data aggregators like Plaid and Finicity and MX could have really actually benefited from, strangely, from the rule being thrown out or vacated by the CFPB, right? Because in a world in which that rule is in place and banks are required to just provide open access for anyone who wants it to their APIs, the base level of what Plaid and MX and others had built in terms of integrations and data coverage sort of becomes less of a competitive advantage or a competitive moat, right? So like in that Rohit Chopra vision of the world, it sort of actually knocks out some of the competitive advantages for Plaid and MX and some of those companies. The middle of the road outcome, which I thought was where we were headed, was, all right, we're still going to have APIs, but we're tossing out the rule, and this data access is no longer guaranteed, which means it's likely that the big data aggregators that already have data access agreements and that already have APIs and that already have good coverage, they'll actually strangely benefit from a lack of a rule because they won't have other competitors coming in. They'll be able to negotiate and use their scale to negotiate with all of the banks, and they'll sort of work out a détente that's going to be like reasonable here. The third road, the most extreme one, I guess this is like the Papa Bear one, where the Papa Bear just growls and is really mad when someone eats his porridge, is Chase throwing this pricing out at aggregators and sort of giving the indication that they just want to kill this market altogether. And to your point, that is, I think, actually very bad for the big data aggregators, because if you can't come to a commercial arrangement with Chase or with PNC or with Bank of America or anyone else who's going to try this, if you can't come to commercial arrangements that make sense for your business and for your end customers' use cases, you're kind of dead in the water a little bit. And then the question is, all right, so what replaces that? And I think the quote from Jurassic Park, like life finds a way, kind of applies to fintech too. Like fintech finds a way. Like if it needs this data, it's going to find a way. And to your point, it's really easy to block a screen scraper when it's coming from a specific IP address in San Francisco and the volume is just like massive. Like you can like detect that, you can stop that. That's easy to do. But how do you stop every fintech startup in the world that now has access to LLMs and vibe coding from just building their own set of, to your point, very janky screen scrapers? And it's just death by 1,000 cuts where everyone is trying to screen scrape you all the time. You have no insight into the permission that they're getting from their customers, how that permission is being managed, who this third party is, and if they can be like in any way validated or trusted. And then to like wrap this all up in a bow, your point is a really good one. In any of these scenarios, the customer is going to call you when something bad happens. And this is why I think the Chase thing is really short-sighted. People are going to share their data. They just are. I know you want to like reset the clock to a time when this didn't exist, but that is like not possible. We live in this world. Consumers are going to share their data. Fintech founders are going to find a way to enable consumers to share this data so they can build experiences on top of it. And when something breaks or goes wrong, or heaven forbid, fraud happens or a scam happens, you're going to take the hit, right? And the lesson I've taken away from Zelle and scams and all of these things is it does not matter if legally, if from a regulatory perspective, you are in the right, you are not liable for these things. If enough of your customers get hurt or bad things happen or they're frustrated, it will land back on you eventually. Elizabeth Warren will tweet about it, and you will end up having to explain yourself. And so, to me, again, a structured, well-regulated market where you can exercise some control, maybe get some money back on the costs that you're incurring, maybe have these like bilateral agreements with different aggregators. Like that is a world that you want because you can exercise some control. This alternative one that we're headed into, I just don't think it's going to be nearly as good for banks, even the largest, most sophisticated ones like Chase, as they maybe think it will. And that's kind of my lingering thought that still sticks in my head as we sort of see how this plays out.
Okay, I feel the need to read one more Jamie Dimon quote, and then we may have to move on.
Okay,
but I think I tweeted this, but it's from the same 2024 letter, and he's talking specifically about open banking and quote unquote third parties want to exploit consumer data, and he says. Contrary to what you may read, we being Chase, have no problem with data sharing, but only if it is done properly. It must be authorized by the customer. The customer should know exactly what data is shared and when and how it is used. He bolded those words. Yep. Third parties should pay for accessing the banking system and payment rails, et cetera, et cetera. And again, not that I expect ideological consistency, and I'm also very aware that the comparison with credit reporting agencies is not like perfectly analogous because banks like JPMorgan Chase have a clear incentive to furnish data as an enforcement mechanism. But I don't recall, voluntarily agreeing to have Chase give my Chase Sapphire Reserve data to TransUnion, Equifax, and Experian. And as I forget who, but as somebody pointed out on Twitter, Chase also has an entire marketing business line that monetizes consumers' data, and I'm guessing
Chase Media Solutions.
Yes, I'm guessing nobody opted into that. So I know it's very, very, I don't know, naive of me to be stunned by the lack of ideological consistency here. But I feel the need to point it out.
No, it's totally fair. I mean, we can move on. I mean, I agree with everything you said. I think the reality of this stuff is just like this is what bare knuckled capitalism with no rules looks like, right? Like the biggest bank gets to set the terms. They get to exercise however much market power they want to. Again, as I said before, I think they maybe are pushing themselves into a world that they're maybe going to regret or have some challenges with later, but they really ideologically, and this isn't every bank, but Chase, PNC, a few others, they just have ideological problems with this, right? And most of them are smart enough not to say out loud that it's our data, it's not the customer's data, but that's how they think. I think is like, this is our data, we built it, we generated it, we protect it, we manage it, we can give consumers access to it, but like you don't get it for free. This is their attitude. And, I'll be very curious to see. The negotiations are ongoing, right? So we don't know if the pricing that was given out is going to be the final pricing. It's entirely possible this was the opening gambit in a larger negotiation with the aggregators. They always say start really low or really high when you're trying to negotiate a price for where you want to land. So maybe it's just that. I think I've seen some speculation from folks that maybe there are other things that the aggregators or fintech companies can do that would sort of help banks get more on board with this. We still don't know the ultimate outcome of the case that BPI has brought against the CFPB. So TBD to a degree, but I think we see pretty clearly the direction that this is headed in. Mr. Mikula, now I'm going to ask you to take us like beyond the realm of traditional banking, because the other big thing that happened recently is, in fact, a regulatory development that's going to have some changes in the industry.
Yeah, absolutely. I mean, while you were enjoying Financial Inclusion Week, it was also Crypto Week, apparently, in DC, and the Genius Act was passed by the House and then signed by Trump, and is now the law of the land. The bill is 134 pages, and I will admit I did not read it word for word, and we will refrain from running through every single specific point of it here. But at a very high level, to frame our conversation, it creates a dual state and federal framework for the licensing and oversight of stablecoin issuers, because why would we not want to replicate our incoherent federal banking system into a new stablecoin blockchain world? 3 categories of issuers: subsidiaries of insured depositories, which can become licensed by their primary federal regulator. So that would be the Fed, the OCC, the FDIC. Non-banks and uninsured national banks, plus U.S. branches of foreign banks, which can apply to the OCC to be licensed to issue stable coins, and non-banks that have an aggregate of less than 10 billion in stable coins issued would be able to apply to their relevant state regulator, assuming states develop their own regulatory regime, which is signed off, and I didn't even put in my notes, but by whatever the crazy new committee is that is composed of the Secretary of the Treasury, the Fed chair, and the FDIC chair. I think it is also worth pointing out, we've already seen 2 stablecoin issuers apply for trust bank licenses, specifically saying that they were doing so in part because it would align with Genius, and that is Circle, which issues USDC, and Ripple. Most importantly, Genius defines the permissible reserve assets, which are primarily basically commercial bank deposits and short duration U.S. government debt. It defines some things related to the bankruptcy regime, which I'm going to be honest, I know that there was some debate there about exactly whether or not the way they structured it was a good idea and how it would work. And I read some of Todd Phillips's stuff and some other people, and I'm not sure I entirely understand it. So I'm going to avoid opining on the bankruptcy part of this. Includes reporting requirements as far as the composition of those reserve assets on a monthly basis. But it's also worth pointing out, as big of a sort of watershed moment as this is, the implementation time period could run as long as 18 months. So the sort of general consensus that I've read is that it'll take through November 2026 for this actually to become effective. So each federal regulator will need to formulate regulations based on this law. And I assume we're still doing APA rulemaking, but who knows these days. And I thought this component was quite interesting. Existing stablecoin issuers have a 3-year grace period from the signing of it, so basically from now, to come into compliance. And the 2 largest issuers of USD-linked stablecoins have taken very different paths when it comes to compliance and sort of transparency. You have Circle, which issues USDC, which, like I said, has applied for a trust charter. I believe they have a New York State BIT license. I believe they have state MTLs as well. So really, making what appears to be a good faith effort to like be compliant with the US regulatory regime. And then you have Tether, which has pursued a very sort of different strategy. So under Genius, Tether would have until 2028 to either become compliant, or, as I understand it from reading some of the reporting and comments from Tether's CEO, Paolo Arduino, who I actually interviewed a long time ago. It was like the first live podcast I did at Money 2020 in Europe in 2022, and the audio quality is terrible, so don't even try to go listen to it. That was my fault, not Money 2020's fault. But as I understand, the plan would be to launch a new stablecoin that is specifically compliant with Genius, while simultaneously working to get the existing USDT Tether stablecoin into compliance, which is an interesting strategy.
Yes.
So this, I mean, as you and listeners probably know, I've done my best to stay out of the stablecoin conversation because I feel like I still want to learn and talk to people, but like this was kind of like too big of a moment not to engage on.
Yeah.
I am curious, I guess, first question to you, and you can pick whatever stakeholder you want. Who are the winners and who are the losers? We've got big banks, small banks, we got card networks, ACH, remittance, consumers. How do you see this unfolding and actually impacting the landscape, presumably not today or tomorrow, but over the next, 1, 2, 3 years?
Yeah, so I mean, it's a great question. I think the obvious winners in this are a couple things. One, I think Circle is very happy and is a good position relative to where it was, just because, as you said, it had staked out a position of we're going to be the stablecoin issuer that leans into regulation. We are going to be the heavily regulated one, and quite frankly, that was a disadvantage for a long time, right? Like they briefly broke with their peg when SVB went down. A lot of market share has actually shifted from Circle to Tether over the last couple of years. I think Tether is seen broadly within the sort of crypto economy as like the easier stablecoin issuer to work with on a number of different levels, not all of which are like good sort of preventing financial crime sort of levels. But like it's been a disadvantage, I think, historically for Circle to try to play a more regulated game without really good federal regulation existing and requiring stablecoins in the US to play by those rules. Now that those rules exist, and I think generally they are pretty compatible with what Circle has already sort of voluntarily been doing or been doing on a state level in the state of New York, I think that they are going to continue to sort of be able to be the market leader in the short term for really heavily regulated stablecoins. I cannot explain or defend their current valuation after going public. It makes no sense to me. It doesn't even make sense to the most ardent crypto defenders. So we'll set that aside. We don't give financial advice on this podcast. But setting that aside, I mean, I do think this is good for Circle and sort of validates their strategy that they've had in place for a long time. The other, I think, immediate obvious winner, and it's kind of an interesting one, but it's consumers living in other countries that want access to dollars. I think that obviously there have been other mechanisms to get access to dollars if you've lived in other countries, but they've always been sort of analog or difficult to access in various ways. Stablecoins sort of democratize access to stable currencies. And so, I always try to remember the folks who live in those other countries and just how beneficial relative to the standard experience they have getting access to dollar-backed assets is. I will say that just because they're getting access to that through this new sort of like explosion of stablecoins we're going to have, I don't think that necessarily means that everything is going to be hunky-dory. I'm always a little bit surprised when we talk about stablecoins, how we never talk about the fact that, well, it's good for those consumers. It's actually bad for the governments in those countries and sort of undercuts their ability to manage their own monetary systems. And I don't know that we've really seen the backlash that's going to form from other countries that get pissed at the US for sort of exporting dollars to their citizens via stablecoins. It's one of those things where it's like it's presented as a feature by advocates in the US. It's presented as a feature by a lot of government officials, actually, and regulators who've talked about the Genius Act and the virtues of it. It's going to cause problems with other countries, I think, and I don't think we know exactly what that's going to look like yet, or how they're going to try to crack down on it, or sort of stop this from happening. So I think that sort of geopolitical lens is one. Jason, the question I want to bounce back to you is: I've heard people say this is good for banks, this is bad for banks. I wrote a piece saying that stablecoins were going to be probably a net bad thing for community banks. We've heard JPMorgan Chase, Citi, a number of other large banks either say they're going to do a stable coin, indicate that they might do a stable coin. What do you think this means for banks?
So I'll admit I struggled with thinking through this question as I was writing up the newsletter on Genius. I do tend to agree with your analysis that there's not really much upside here for small banks.
Yeah.
The only, minor silver lining I could come up with was potentially serving as on and off ramps.
Right.
Which I know there's some banks I know we promised we weren't going to BaaS Island, but some banks in the partnership space,
sure,
that do specialize in some of this stablecoin infrastructure work.
Mm-hmm, mm-hmm.
I'm not sure that is a significant counterbalance to some of the potential, negatives or losses, competitive challenges that they're going to face from consumers, but potentially shifting what had been bank deposits into stablecoins. I mean, I know, and I think I saw you had tweeted something in regards to Brian Armstrong, who's the CEO of Coinbase. The measure itself prohibits issuers from paying interest, meaning, so Circle can't pay interest on USDC, with at least part of the argument being that should help blunt any risk of deposit flight from the banking system into what's functionally like a money market, but this sort of stablecoin ecosystem. But the glaring loophole is that other actors are able to pay whatever you want to call it, interest, yield, rewards, to incentivize consumers to hold those. And so if I can earn 4 or 5% on my USDC that I'm holding on Coinbase, because Coinbase gets rev share from the issuer, Circle, who in turn is parking all of the reserve assets in treasuries, that, whether or not you acknowledge it, that becomes competitive to holding money at small town bank and trust, and for that matter, big banks. I mean, my thought process on the calculus for larger banks, one, and you've done a great job talking about this in other types of bank consortiums. Banks don't tend to be great first movers or innovators, but when they see a competitive threat, whether that was like Cash App, Venmo, or open banking with Akoya, they do tend to be pretty effective at using their size and using their market power to respond, and sort of often respond by building their own closed garden, right? So for instance, EWS, early warning, that data, which in addition to operating Zelle, EWS shares checking account usage and fraud data, as I understand it, is generally not available to fintechs. So if you wanted to use that for whatever reason in your product, when I was in payday lending, we actually, at the time, used EWS data as part of underwriting for fraud screening. That's actually not available to you. And so I know there's been some reporting that, major banks are considering creating some sort of consortium to issue their own stablecoin. JPMC has actually used its own coin, JPM coin, sort of like internally on like a closed loop, permissioned basis. I know that Jane Fraser, CEO at Citi, made a nod to this on the most recent earnings call. Personally, the piece of it I find potentially more interesting is the idea of tokenized deposits as opposed to stable coins, although this seems to be a very early stage, very nascent idea. But I mean, to me, it's like, okay, outside of the crypto use case that gave birth to this idea of a stable coin, which it feels like, mainstream banking and fintech industry have moved well past that trading use case. A stable coin fundamentally feels like a stand-in for what people really want, which is a better rail to move dollars. And so if you can tokenize a deposit and have the 24/7 always on instant settlement, blah 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 blah, like if I can do that with a tokenized deposit that also benefits from the safety and soundness of too big to fail JPMorgan Chase or
FDIC
benefits from
insurance,
FDIC insurance, then why would I use this other thing? Except maybe for priming, but that's what Tether's for.
Well, that's the question, right? Because, and I the number one question I had for everyone in DC during Crypto Week, which I wasn't really there for, but as long as I'm here, I might as well ask a couple questions and poke around a little bit, was why would you use a stable coin, let's just say USDC, if Chase offered a tokenized deposit product, right? Same infrastructure, same rails. It's programmable, it's instant, it has instant settlement, it's global, blah, 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 blah. All of the things that a stablecoin does because it's built on a distributed ledger, tokenized deposits can do, but because it's a tokenized deposit, it has safety and soundness, it has FDIC insurance, it can pay yield, right? Like if it's a tokenized deposit, it's not subject to the restrictions on being able to pay yield. It seems like in every way it's a superior product. The only, and this maybe touches on your criming point a little bit, the only difference that I thought was interesting, I hadn't really considered, was stable coins are a bearer instrument, meaning that whoever has the stable coin has the money, right? It's like cash or a bearer bond or a cashier's check. Like there are certain financial instruments where possession entirely defines ownership. Stablecoins are like that. And that form of stablecoin is allowed under the Genius Act, right? So you can get USDC and then you can, in a permissionless peer-to-peer fashion, keep it in your crypto wallet, send it to someone else in their crypto wallet, and you can exchange it just the way that we do cash. Now, that creates a whole bunch of money laundering concerns. And I know that Treasury is really, really keenly looking at and studying and trying to understand, what does it mean when we essentially digitize cash in that way and make it sort of instant and global and permissionless sort of by default. So there is that question. There'll probably be a lot more scrutiny on on-ramps and off-ramps to your earlier point. But the interesting question is, if you have a tokenized deposit, do you choose to make it a bearer instrument or not? And my understanding from talking to people is it is likely that regulators will allow banks, if they want, to make their tokenized deposit product, if they choose to offer one, similar to a stablecoin in that fashion, where it can be a bearer instrument. Now, what I've heard is that Chase's initial sort of moves in the tokenized deposit space are not. They are one where anyone who wants to use their tokenized deposit has to be onboarded. It has to go through their KYC process. It's kind of a closed ecosystem in that way. But you could imagine another bank coming along going, hey, we're going to offer this same tokenized deposit product, but in order to appeal to the people who like to use USDC or to the people who like to use Tether, God forbid, we are going to create more of this permissionless, use it like cash form of tokenized deposit product. And I think that's one of the big unknowns, but possible distinctions in the tokenized deposits versus stable coins. And candidly, going back to your earlier point, a lot of this is going to depend on how the rules end up being written, right? We have the Genius Act, which is great. It's not overly prescriptive from what I've heard from lawyers who've sort of actually read the whole bill cover to cover. And that is sort of funny in a post-Loper Bright world where regulators are going to get less deference from courts than they used to. But the regulators are going to have their hands full writing this rule, presumably going through the standard Administrative Procedures Act process, and really trying to nail down some of these questions, because they, I think, even more than the law, are going to determine market structure, winners and losers, how many stablecoin issuers end up being viable, some of the questions that we have on this.
Well, that is also a really interesting point at a time when I'm not sure if you've noticed, but like they've like fired and laid off a lot of people across the U.S.
I have noticed that. I have noticed that. Yes.
And the idea that not only are the existing regulators going to be responsible for formulating new regulations necessary to implement Genius, going through the licensing process for who knows how many stablecoin issuers, but potentially quite a large number. While Tether and Circle account for the lion's share of USDC stablecoins in circulation, there's like more than 200 USD pegged stablecoins, which will either need to make a choice to become licensed and become compliant, or I guess become what I understand the industry is calling like an offshore stablecoin. And then as this market gets up and running, actually supervise these issuers. And something tells me, you were just at the Fed, so you had a firsthand point of view. I suspect that most of the existing bank regulators don't necessarily have a deep level of expertise when it comes to these kinds of topics and questions that we're talking through, which poses a challenge to regulate a stablecoin issuer if you don't currently have the literal staff and expertise to do so.
Yeah. Well, I'm glad you're bringing that up, because, I mean, the thing people always forget about the regulatory side is we just sort of assume there's like this unlimited pool of regulatory capital available to enable whatever thing we want to do. And that is just not true, right? Like whenever you talk to folks on the regulatory side, what they will tell you is they are understaffed and just buried under work, right? And so it's not like the OCC was like teeming with examiners who are just sitting around with nothing to do. And now they're going to have, and I guess like they won in the sense that they're going to get a whole new category of chartered institutions to oversee and to collect assessment fees from and stuff. So like, in a sense, I think the OCC is happy that like this is falling under their umbrella, but it's going to be a ton of work there. I mean, I can't really imagine they won't need to hire more people. And again, this is happening in the backdrop of regulatory agency staff being cut and being reduced. It's going to be a ton of work, and I'll be very curious to see how they prioritize the sort of enforcement, the supervision, the chartering of these institutions. I think the other question, Jason, and you brought this up earlier, is how many companies in this space do we see just opt to become a bank entirely, given that the window is also open for that? There's a real push to get access to Fed master accounts, which is kind of a critical component, which I know you've written about with some of these new companies that are trying to get these trust charters. So, I mean, there's a lot of different moving pieces that are going to really impact regulatory agencies on a number of different levels.
The last piece on this, and then we'll get to our can't let it go. Just because this came across right before I hopped on to record this with you. The banking associations are not big fans of those new charter applications.
No, they are not.
A letter from ABA, CBA, NBA, ICBA, and America's Credit Unions, which I've honestly not even heard of that one.
Me neither.
Basically a comment letter regarding the trust applications for the various ones we mentioned, as well as Fidelity Digital Assets, because they applied for one as well.
Right.
So it as with all things, incumbents will use the levers they have to push back to preserve the regulatory privilege that they have. And yes. I will be very, very interested to see, both on the chartering front, as well as on the somewhat inside baseball, esoteric, but very important Fed master account front. It's like, okay, like there definitely has been a change of administration in Washington and a change in tone at top of these regulatory agencies. Yeah. But sort of where the rubber hits the road of like granting a charter to Circle, granting a charter to Ripple, giving a Fed master account. Like, how does that happen? And if so, how quickly does that happen?
Yeah, it's not a sure thing, right? As you've pointed out in your newsletter a few times. None of this stuff is for sure. And I think, the clock is ticking also, right? Because like there is a window right now to get this stuff done. That's why the Genius Act was such a priority in the first place. I think that tying back to our earlier story, that's why Chase is kind of doing what they're doing right now with open banking. Like there's a window to reshape the market in a way that you want, but it is a ticking clock. And there is definitely a looming possibility in 4 years that the environment you're operating in and even the rules that you're operating under might change significantly. So we'll continue to monitor stablecoins, open banking. We'll probably make a visit to BaaS Island in the future. Mr. Mikula, before I let you go, give me something that you can't let go of.
Okay. So I know you and I know, deep sigh. You and I both have discussed, and I think have broadly very similar feelings about like betting and the sort of financialization of everything, which is very much exemplified by the idea of like events contracts and the rise of some of these marketplaces. That intersected with another story that not only took over the entire internet for several days, which I'm sure anyone listening to this is familiar with, the astronomer CEO getting caught at the Coldplay concert. I'm going to refrain from passing any judgment one way or the other on that. But the fact that you are now able on Polymarket to wager on whether or not that guy gets divorced, I find just abysmally disgusting. Like, regardless of whatever choices he made and the HR person made, like, the fact that you can wager on whether or not they will get divorced from their spouses really is like a sign of the disgusting nature of late stage capitalism that I am just so deeply troubled by. That's all I have.
I couldn't agree more, man. I've ranted about the prediction markets, and in fact, I tweeted specifically about like prediction markets suck because of this exact example. And it's funny because the pushback you get is, well, prediction markets function to create more like efficient markets and to like find truth using like the wisdom of the crowd and whatever. And it's like, all right, fine. I don't necessarily totally disagree with that. But if that was your mission, if that's what you were motivated by, if that was your social purpose, you wouldn't take bets on if someone was going to get divorced. The reality is there is no social benefit to finding out the truth. I don't even know how anyone would try to find out the truth of betting on whether someone's going to get divorced. That's just like ghoulish wagering behavior, and these markets monetizing interest from the internet on these people's private lives. Like, it has nothing to do with us. And the fact that we can bet on it, I could not agree more. Is honestly, it makes me just want to like unplug everything from every outlet and just go live in the woods, which I may do at some point, Mr. Mikula. But if I were to do that, I would lose access to following Bill Pulte's Twitter account, which would make me sad, candidly, because
I resent that you encouraged me to follow him, by the way.
Yes, sorry, I got him. I got him addicted to the Twitter account. No, I mean, it's like, I just feel like I have to share it with anyone I can because it's incredible. And once you follow it, you can't stop. And it's this crazy mix of like trying to ruin FICO's life, which I've written about, trying to find ways to bring down costs for homeowners, which is, I guess, ostensibly a good thing. Trying to get Jerome Powell fired, which he is like deeply obsessed with in a way that like, find someone who is passionate about you the way he's passionate about getting Jerome Powell fired. And then finally, his just sort of strange use of Twitter generally. And that's the thing I can't let go of, because he will, in kind of typical, and this is, I guess, sort of similar to how his boss uses social media platforms, but like there's a lot of capitalization of random words. And then the one that's killing me is there's a lot of quotation marks randomly. And so like, for example, he recently tweeted, today we allowed for rent, all caps, payments to count, all caps, towards qualifying for a mortgage, all caps, if Obama, quotation marks, or Biden, quotation marks, did that, they didn't, it would be nonstop news coverage. that is just like a great combination of like unhinged all caps in random places, quotation marks around Obama and Biden's names as if to indicate that those aren't actually their real names. I don't know if he knows like what quotation marks are meant to convey from a meaning perspective, but like just randomly putting those in quotes. And then, of course, the complaint that he's not getting enough news coverage, which is like very, very on brand. So everything about it is a perfect encapsulation of, I guess, the hellscape that we're living in. But at least it is mildly entertaining, and I do enjoy it.
My favorite one I saw was he tweeted something related to the, like, trying to get Powell fired.
Yeah.
Then that tweet became a news story that he like wrote something, and then he tweeted the news story and I think like talked about himself in the third person. And I'm like, you've just like, it's inception of tweets. Like, and then I deleted Twitter from my phone because my brain is rotting.
Yeah, you were like, is Powell actually getting fired? Like, why do we even think this is happening? It is a truly strange and really remarkable use of Twitter that, you know, again, if I'm going to be on this platform, I might as well be entertained, and it is entertaining. So, Mr. Mikula, I found it greatly entertaining to record this podcast as always. We will be back at it again next month. A couple of months from now, I think we're actually going to see each other in person, maybe at one or two places. So I am both super nervous about the fall travel schedule resuming, but also excited to see you in person. And until then, thank you, sir. This was fun.
Talk to you soon.
All right.